Hello, you are welcome to Easy Forex Special Trading Model to master in 2025. This is going to be for people that have basic knowledge in SMC or ICT trading. Because if you don't have that basic understanding or foundation, then this model is not going to benefit you. So it means this video is not for you. All right, so let's go straight into the video. Please stop all other things. All right, so the trading model is going to follow this set of rules. All right. And the first rule is that you need a confirmed break of structure or market structure shift, right? And then you are going to also need a return to discount PD array. And that means below 50% of your trading range. All right. And you have other blocks, fair value gaps, and breaker blocks for your entry. All right. So those who also understand demand and supply zones can equally use it. And fair value gaps are also known as imbalance. All right. So before you take this course, I presume you must have known your basic market structure. All right. Basic market structure. You should understand premium and discount too. You should understand order blocks. You should understand fair value gaps, FVGs in short. Let me put slash imbalances. And then number 5, you must understand breaker blocks. All right, so these are the 5 components you are going to work with as far as this strategy is concerned, right? And then that is it. I think that is it. That is it. That is it. So you need that. You need to understand basic market structure, premium and discount tool or array. And then you need other blocks, fair value gaps, imbalances. It's not a new strategy, but I'm just simplifying what may seem to be so complicated when other teachers are teaching it. All right, that is what makes this lesson a bit special or different from the others. Now, we are going to look at the first instance where we have a bullish market structure. So in a bullish market structure, you understand that price will keep giving you what? Break of structure. Price will be breaking highs and setting new highs. All right. Now, after the first break of structure to the upside, we need markets to return below the 50%, which is 0.5% of your trading range. So let's say this is your low and this is your new high. All right. So if market is pulling back here, you want to see market go below the 50% zone or 0.5, which is what I've indicated with this dotted line. And that is the only thing that is going to make you interested in taking a trade. So for instance, in this case, where we had this little pullback, did not go below the 50%, it means even if price gives you an order block or a fair value gap here, you are not going to trade from there because you'll be trapped, all right? So this pullback, which did not go below the 0.5%, becomes liquidity for the fair value gap or order block that is below the 0.5% or the extreme, right? So you are going to avoid a lot of traps when you are using this strategy. So allow market to pull back below the 0.5, which is the 50% level, into a discount zone. We call it a discount zone. And then look for lower time frame structure confirmation and you take your trade to the upside. That is if you are bullish, right? Now, the second thing is you also need price. You are going to need only two POIs. You are going to trade from two POIs. So below the 0.5, you are going to identify only two areas which you'll be interested in trading from, not more than two, right? So the first rule is that there must be a break of structure. There must be a pullback below the 0.5% into either a fair value gap or an order block. So the two areas you are going to be interested in taking your trade from will be the first one, which is where the move started from. Identify your demand zone or order block there. And then below the 0.5%, you identify a fair value gap or an order block around that zone as well. So these are the only two things that are going to guide your trading setups. And trust me, if you stick to this, you are going to avoid taking a lot of trades and losing unnecessarily. Which means that if price doesn't do any of the things I've described, you are not going to take the trade, right? So you'll be looking at chart examples very soon. So actually, this one is a liquidity concept, right? This one here is a liquidity concept. And this model here is what explains our entry criteria. All right, so there must be a break of structure to the upside. There must be a break of, that is if you are bullish, there must be a break of structure. And price must pull back to below the 0.5% into either your first POI or your second POI. Anything apart from this, it means that if you are getting the scenario very well, in every trade setup, you are going to have two opportunities to trade, which means you have this first opportunity here, and then you have this second opportunity. So assuming this one didn't go right, price violates that area. You have this last area to take your buy from, which means that if this area gets violated, then you are no longer going to be buying, but wait for price to retrace back into premium or above the 0.5%, then you take your trade to the opposing side. But that is for another time. So let's stick to what I just said. So make sure that you take particular notice of what we have discussed here. Take a particular notice of that. So we are moving straight into the chat for our example, chat example. All right. So we are going to go to one asset and we look at how we are going to apply the model in taking trades. And this is going to help us to avoid so many things. All right. All right. So let's go to our chart and learn our strategy. Let's go to our chart and learn our strategy. So you can use any time frame at all, any time frame at all for that for that module. Can you use any time frame at all? I'm loading the chart. All right, we are going to pick one asset and go over the trading model that we see how we could apply it on our chart. So we have VIX 25 daily time frame. And if you are going to use the daily time frame, we are not going to find much entries. But let me just go to the one now. Let's see. So this is our VIX 25 1 hour time frame. And let's first of all go on. We have this low being taken out, and right after market gave us what? A break of structure, which I'll label BOS. Now, after that break of structure, we had this high, all right? And market tried to pull back down, but it couldn't come much. So this was some sort of a range. This was a range. And we were going to expect markets to what? Pull back. So we are going to mark our range high and our range low. So in this instance, you use this for your range high and for your range low. We said that from the range high to the low, you use your premium and discount to for that. And you are going to mark the 0.5 level, and then you remove your premium and discount too. So this is what is going to guide you. If market doesn't come below this line, you are not interested in trading. And in this case, market never came, all right? So we didn't have a trade. But in case market should have come down, we say we are going to identify only 2 points of interest. So we have this extreme order block as our first one, and then we have this fair value gap as our second POI. And you could see that market never came back there, so we didn't have a trade. We didn't have a trade. We didn't have a trade. Let's move forward. Now, we have this low, we have this high, we have this low, we have a higher high. So there was a break of structure here. Okay. There was a break of structure here. And market gave us this high. And we had what? This is our range low. All right. So we label this as our US. Put it on top. Now from our range high to our range low, we are going to use our premium and discount too. We just stretch it this way. Then we are going to mark the midpoint, 0.5 area, which is this zone. And then we are removing this. So what we are saying is that our model, we are going to identify an order block or fair value gap that is below this line. And look at it. We have this down close candle as our first POI, which is even closer to our second POI, which is the fair value gap. So there's no point in marking that one. But look at it. Price came exactly there. moved away, gave us what? A market structure shift here. And then it returned back into the order block, 10 minutes or 30 minutes order block here. So clear on the 30 minutes, 15 minutes. So we can see that after the break of structure on the 15 minutes, we had two POIs like we have already marked. We have this extreme order block here. We had this fair value gap that was also below the 0.5 line. And look at it. That was where market returned so deep to that zone and it bought. It moved away. So we had a market structure shift here and market returned to this last down close candle here. Information entry. This was a good entry for us. Stop loss right here. And if we had gone for this target, it was so smooth. All right, so moving forward, we had a break of structure here. Break of structure, and we mark our range low. So this is our range low, and this is our range high, where we had a break of structure, our range high. So from our range low to our range high. Now this becomes our new range low, all right? And this becomes our new range high, where we had that break of structure. So from this low to this high, we are going to mark with our premium and discount tool, and then notice the 0.5 area, delete this one. And we are going to wait for market to pull back below here. And below here, what do we find? We need an order block. We have this order block, which market didn't use. And we also have this fair value gap, which market can use. So these are our 2 points of interest. It's either we take the buy from the fair value gap or we take it from the order block, which market didn't come. So we didn't have a trade. You avoided this trade. Now, we have a break of structure here. Of course, you don't have to be doing this BOS thing, it delays, but just for your learning. And we have our range low here. And price gave us a range high here. All right, so this is our new dealing range. So from this new range low to this high, we use our premium and discount to from the low to the high, and then we mark the 50% level, which is the equilibrium, and we allow markets to trade back down, and markets didn't come. And if market had come, what other block could we have found? We have this zone here that has this fair value gap. So that is our first POI, fair value gap, and our second POI is the order block. And since they are close to each other, you can ignore the fair value gap and use the order block. So market didn't come, so we didn't have a trade. All right. Now, this was our new low that gave us this break of structure here. Our new low that broke structure and gave us what? This new high. So from our new low to our new high, mind you, we are using the 15-minute time frame. We mark the 0.5 level, delete this one. And below the 0.5 level, what do we find? We have this demand zone, order block, with this huge imbalance, part of it also here. And look at it, price came all the way down. And this is only when you take a trade, right? The stop loss go right there, give it a little room to breathe. And then you go for your target. If 1:5 or whatever, or previous highs, you can use that. And this was a good trade, right? And this is our new break of structure to the upside. This is our new break of structure. And this is our new range low, right? We have a new range high here. So from this low to that high, you mark your 0.5 level. And below the 0.5 level, allow market to what? Trade down into that. And what do we find? We have this nice fair value gap here. And that was your entry. Your stop loss could be somewhere here. And then you go for your target. If it's 1:5 or whatever, 1:3, you had that nice one. Right? So that is how you keep following price. And from this, let me delete. And delete this one too. From this range low, market kept breaking structure, but not so nicely. So this is our new range high that we're going to use. This becomes our break of structure. All right, so from this range low to that range high, because here market wasn't so clean, so you allow price to go to that high. Why is our 50% level here? Delete this one. And you allow markets to trade back down. And here, because there are no imbalances here, price was not interested in coming, so it didn't come. All right. So we form this new low here. It becomes our new range low. And we broke structure to the upside. And formed a new high here. All right. So from this range low to this range high, you mark with your premium and discounts to mark the 0.5%. And allow market to retrace from here, but it didn't come. Why? Because there are no imbalances here. So you notice that's where there are no imbalances, price is not interested in returning. All right. Price is not interested in returning. So we had this break, and this high was formed, and this low was formed. So this becomes our trading range from this low to this high. But you could see that this trade wouldn't have held because this was not a confirmed break of structure. This was a liquidity grab. Though we had a candle body close above it, but not with much momentum. All right, so the momentum is very important. This is a money star formation, a doji, a bullish candle, a doji, and the market started what? Retracing to the downside. So from here, we had a market structure shift here. when market is to return into what? This is a bearish case. From that high, we had this low, and market started retracing. So from this high to this low, where is your 50%? Here. So you allow markets to trade back above the 50%. And what do we find there? We have this fair value gap. We have another fair value gap. And then we have an order block. And we say we are going to use only 2 points of interest. So because of this order block, I'll delete this fair value gap. So this is in premium. This is also in premium. And price surpassed that to go into the order block. And so, all right. So if we were going to go bearish, price should have broken this low, the candle body, to signal that we are going to go down more. But look at it. Price just came and stood here by respecting this order block. Right. So we resume bullish again from here, where market went ahead to break the structure. Right. I hope you are following. So this becomes, let me clean it up a bit. We broke this structure here. So this becomes our new low, which must be protected. Price shouldn't break. And this is our new high that was formed. So this becomes our dealing range. So from this range low to this range high, you mark with the premium and discount. You mark the 0.5 level, you delete this one and leave it there, but I want my chart to be clean. So this retracement, you allow it to come below the 0.5 level. We say we need only 2 points of interest. We have first this fair value gap. And then lastly, we have this order block. You can see that price didn't respect the first fair value gap. I came to respect the order block. So even if you took the trade from here without confirmation, the stop loss was going to be somewhere here. You would have lost the first one. So this first point of interest did not work. But the second one, which is the order block, you still had opportunity to take a buy. And look at it. When price came there, there was a rejection there. See that morning star formation? Bearish candle, a doji, and a bullish candle. So that was your buy signal. But from here, stop loss should have come somewhere here, but your target will be this high. And see how price, although went sideways, but was able to finally hit your take profit for you. But in this case, I wouldn't have taken this trade. The stop loss would be very wide. Another way you could have entered was wait for market structure shifts, bullish. So from this low, this is more of a confirmation entry. Market gave us this high. So that is our new dealing range. This range low to this range high, premium and discount to mark the 0.5% level. And beneath that, we don't have any fair value gaps, except that we have another block here, which price came into, and perhaps price action isn't so clean, but you could have followed in that action until this high was broken. From this range low, we broke the high to form a new high here. So even if you are taking a wider range at 0.5 level, we're going to expect price to come, but it didn't, because there are no fair value gaps here. Price has sufficiently delivered by filling all the fair value gaps or imbalances, so it didn't really come back there. So it was no trade for us. It looks so choppy. But after this break of structure, it was this low. I put in this high. So from this range low to this range high becomes our dealing range. At 0.5 level here, and below our 0.5 level, we have an We don't. We don't really have another block except for this down close candle. There is no fair value gap, so it looks unattractive. But price came back to use this demand zone again, and it broke structure. Okay, so this becomes a new low, and this becomes a new high, and this is our break of structure. So from our range low to our range high, we mark the 0.5%. What other block do you have? You have this one here, and we have fair value gaps. A lot of them, but you could use any. You can use the first one here. Your first POI. And then there's a second one beneath, which confirms the other block. So price came and took out the low. So we switched bearish from there. All right. So you had the market changing structure from here, from bullish to bearish. And market kept selling to the downside. That is why when price returned back to this other block, gave a reaction because from there market changed. Market wanted to go up also. This break structure and confirmed by also taking out this tenor high. More importantly, for us to confirm that break of structure. So we switch bullish again. And from some demand zone right here, we had that break. So this is our range low, our range high, premium and discount 0.5% level. That is the equilibrium level. And came into that other block of 15-minute fair value gap. So we have this fair value gap here, which confirms our other block, the demand zone for us. So that is what price used, and it bought massively. Stop loss could have been somewhere here or there, around the 15 minutes, so or TP1 here. In that fashion. So that is how markets has been behaving using our strategy. You can see that it's not difficult. Just make sure that stick with it more and learn. It's going to help. Where is our range low? We had this range low. A new low was formed, which gave us this break of structure. From our low to our high, this is our equilibrium or midpoint, 0.5 level. We say we want markets to retrace into the equilibrium level or below that, and we have this demand zone here. And our other block, I also have this extreme other block. So first we tapped into this one, went ahead to break structure. And market failed to break this high. So definitely market was going to clear some liquidities. That was it. So this has been the strategy. Thank you very much. Make sure that you stick to it. You learn, practice. So perfected the art. Zero 0.5 equilibrium level. Price came and danced around the 10-meter wave. So ideally, price moves away from the equilibrium level and that creates structural liquidity, creates some sort of liquidity. So markets target that to tap into the zone proper and move away from here when we have a breaker block, have the extreme end as well. So to be safer, if your account is good, you can take your entry here, stop loss somewhere here, move for a higher target. So that is how you go about it. Thank you so much. We'll meet some other time.